You've heard the phrase before, the canary in the coal mine. Back in the day, coal miners would carry a caged canary into the tunnel with them, not as a pet, but as a warning system, because if there was poisonous gas in that tunnel, gas you couldn't see or smell, the canary would die first, and the miners would know to get out and to get out now. Right now, the world has its own canary, and it's not what you think. What is currently going on in the Middle East is an insertion, a wedge that should never have happened, but it did, and it's accelerate what is about to happen. The canary is Japan. Yes, Japan, the world's fourth largest economy. And ladies and gentlemen, that canary is looking very, very sick. Today, I'm going to walk you through four massive financial forces converging in Japan right now, forces that most people have never even heard of. And I'm going to show you exactly how they connect to your mortgage, your grocery bill, your job, and your future. And then, because I'm not here to scare you, I'm here to equip you. I'm going to give you two very real paths out of this storm. Let's get into it. Before I show you the warning signs and the domino chain, you need to understand what is driving all of this. There are four forces, four factors converging at the same time. And here's the critical word, simultaneously. Each one alone is a problem. All four together, that's something that we've never seen before. Let me start with something that sounds incredibly boring, but is absolutely important. For decades, Japan kept its interest rate at near zero, the lowest in the developed world. And smart money, hedge funds, insurance companies, big institutional investors, they figured out something, and they figured it out at their advantage. They borrowed money in Japanese yen for almost free. Then they convert that yen into US dollars, Australian dollars, and other currencies. And they would invest that money into assets that paid 4, 5%, even higher returns. And they pocket the difference, rinse and repeat. This is called the yen carry trade. This has grown into the largest trade the world has ever seen. How big? Analysts put the core leverage position at around $2 trillion. But when you include all of the related positions, currency swaps, derivatives, Japan's entire government balance sheet, Deutsche Bank put the broadest measure at around $20 trillion. For decades, it worked, and it worked beautifully until Japan recently started raising interest rates. When interest rates in Japan goes up, the math falls apart. And suddenly, that free money isn't free anymore. Investors have to unwind their position, and they have to buy back the yen to repay their loan at a higher rate. Now, when everyone does this at the same time, it creates a chaotic feedback loop. We already had a preview of exactly how bad this can get. On August the 5th, 2024, one single day, the Japanese stock market plunged almost 12.5%. That was the worst single day since back in 1987, the Black Monday crash. And it was so bad that the South Korean market halted their trading. The S&P 500 dropped 5% in 2 days. Bitcoin collapsed below 50,000. The Wall Street fear gauge, the VIX, spiked to levels we had not seen since COVID. And what caused all of that? 0.25% interest rate hike in Japan. That's 0.25% or a quarter basis point. And that all happened. Now Japan is at 0.75 and rising. The Bank of Japan is signaling that they're going ahead with 1% to 2.5 in the near future. As one analyst put it, you can't unwind the biggest carry trade that the world has ever seen without breaking a few heads. And that's something to worry about. Let's call this the debt bomb in slow motion. Japan's national debt is 237% of its national GDP. Let's put that in plain language to understand. If you earn $100,000 a year and you owe $237,000, that's what we're facing. And by the way, that's not a mortgage. That's just total personal debt. Japan has the highest ratio of any major developed country on earth. For a long time, Japan got away with this because interest rates were near zero. If you're not paying much interest, even on a mountain of debt, it's manageable. But rates are rising now, and Japan's debt servicing costs, just for the interest payment alone, hit the highest in record history. They're spending 25 cents per every budget dollar on servicing their debt. That number is growing, and it's growing fast. Here's where it gets dangerous on a global scale. Japan's government bond, called JGB for short, are held by Japanese institutions, pension funds, and insurance companies. When the bond yields in Japan rises enough, those institutions and investors start pulling money back home. They stop buying foreign assets. They sell their overseas holding. And what's the number one overseas holding for Japanese institutions? US Treasury bonds. Japan holds almost 1.2 trillion in US Treasury bonds. That makes Japan the single largest foreign holder of US debt in the world, more than anyone else. When Japan's own bonds becomes more attractive, Japanese money starts flowing home. That means US Treasury bonds are stopped being bought and might start getting sold. Japan imports over 90% of its crude oil, and 88% of that comes from the Middle East. Let me say that again. Japan imports 90% of its crude oil, and 88% of that crude oil comes from the Middle East, specifically through the Strait of Hormuz, that narrow 21-mile bottleneck through which 20% of the world's oil supply passes every single day. With the Iran conflict, oh yes, we can't call it a war because that's another day's conversation. As I was saying, with the Iran conflict and the disruption in the Strait of Hormuz, Japan is uniquely, catastrophically exposed. Oil prices have already surged past $100 per barrel. What does that do to Japan? Three things. Three things happen fast. Inflation spikes even harder and higher. Japan is already dealing with a CPI index of over 2%. In May 2025, rice, Japan's dietary staple, surged 101% year over year, the largest increase in half a century. Two, the Bank of Japan is pressured to raise interest rates faster to fight inflation, and it's inevitable. Three, faster rate hikes equals more carry trade unwinding, equals more treasury selling. It's all connected. Japan's oil vulnerability is the accelerant. It is the gas we can't see or smell. The fourth force is something most people have never even heard of, but it's the one that is sure to turn a crisis into even a bigger catastrophe. Private credit is a $3.5 trillion shadow lending system, not your regular bank. These are investment funds, hedge funds, insurance companies. Yes, the same ones we spoke about in force number one. The ones who borrowed the yen at almost 0%. Well, guess what? After lending those monies directly to businesses, these same businesses are having trouble repaying, and of many of which have defaulted. This is how the web is completed. Private credit grew massively after the 2008 financial crisis, when banks got more regulated and businesses had to go looking for money elsewhere. And it worked fine for a while, but here's the danger. Almost all private credit loans are floating rates, meaning that when interest rate goes up, borrowers instantly pay more. And right now, the rates staying higher for longer, companies that borrowed cheaply can now no longer afford those payments. This isn't hypothetical. The signs are everywhere because you never see smoke without fire. And here's how it all connects to Japan. When private credit starts unwinding, global assets get sold at a fire sale. More pressure is put on US treasuries, more pressure is put on the global market, more volatility feeding back into the yen carry trade. Four forces all pulling in the same dangerous direction. Okay, now that you understand the four forces, let me give you something tangible, something practical. Think of this like warning lights on your car's dashboard. One light on its own might be a minor problem, but 2, 3, 4 lights start flashing at the same time. You don't want to keep driving, and you don't want to hope for the best. You pull over, that car is telling you that it needs servicing. And here's what to watch for. Think of this as a pressure gauge on the yen carry trade. When the yen sits at around 160 to the dollar, the carry trade is still alive and people are still borrowing yen cheaply. But Japan's finance minister have already said that they're fully prepared to respond at any time to the yen weakness. Translation: if the yen falls much further, Japan will intervene, and that means selling US Treasuries to buy back the yen. Simple, that's it. That's the play. Japan's government bond yield is the interest rate on borrowing money in Japan. When this yield rises towards 2.5, something specific happens. The Japanese investors decide that they would rather keep their money at home rather than investing in US Treasuries. When you can get a comparable return on your own currency without the currency risk, why would you even think of doing otherwise? Warning light number 3. This is the simplest one. Oil above $100 is stagflation trigger. It means inflation stays high. Central banks can't cut rates. And countries like Japan, which imports nearly all of their oil, faces exorbitant pressure. When oil sustains above $100, you have stagflation, rising prices, and slowing economy simultaneously. Warning light number 4. The US Treasury yields are like interest rates on the US government credit card. When that yield approaches 5%, it's a signal of a fiscal crisis. Here's why that matters to you directly. Mortgage rate tracks Treasury yields. Credit card rates track Treasury yields. Car loans track Treasury yields. Are you getting the picture? Are you understanding? The government's own interest payment is already at $1 trillion per year. Warning light number 5, private credit redemptions. This is the most obscure warning light because it is an indicator that is a new accelerant. It's one of the most dangerous ones because it's not that we've not seen it before, but we've not seen it to this magnitude. When private credit funds start gating, meaning that they block investors from taking their money out, it's a signal of liquidity crisis in the shadow banking system. It's already happening in isolated cases. Blue Owl Capital banned retail investors from cashing out of one fund. So here's a rule of thumb. When 2 or more funds gatekeep redemption simultaneously, treat it as a check engine light turning red. The financial engine is overheating. Those are the 5 warning lights. And right now, lights 1, 3, 4, and 5 are already flashing red. Here's the thing. This isn't just a story about Japan. Japan is the trigger, but that bullet ricochets anywhere and everywhere. Let me walk you through the domino minefield in plain English. The Bank of Japan keeps raising interest rates. Japanese money starts flowing home. Japan, the world's largest foreign holder of US Treasury, starts selling. Not all at once, but steadily. Not because they want to, but because they have to. More Treasury sold equals yield rise. Basic supply and demand. The US government has to offer higher interest rate to attract buyers for its own debt. The US already spends nearly 1 trillion on interest payments in 2025 alone. Higher yields means that your mortgage rate goes up. Whether you are renewing a fixed rate or carrying a variable rate, higher treasury yields means higher mortgage rates. For millions of homeowners, that renewal could add hundreds and thousands of dollars to monthly payments. Your credit card rate climbs. The average credit card is already above 21%. If treasury yields spike, that number goes higher. Debt that was manageable before becomes a trap. Your car loan costs more. Your grocery bill rises. Oil above $100 means that trucks that deliver food, every tractor that grows food, every ship that moves food costs more to operate. Those costs lands on the supermarket shelf. You pay them. Your job gets less secure because companies are drowning in expensive debt and they stop hiring and some start firing. I know you're seeing the bigger picture because this is the reality that we are in right now. US job losses, even before all of this insurgent, that was bad enough, but now it is almost guaranteed. So, what do? I can't tell you what to do, but I can tell you what I would do. Every storm has 2 kinds of people in it: those who are caught in the open and those who built shelter before it hit. Right now, you need to build your shelter. Here's what that looks like. Exit 1. Geo-Arbitrage has gone from a fringe concept whispered about in expat forums to a mainstream financial strategy. And the numbers explain why. In 2025, Harris poll found that 52% of Americans believe that they could live a higher quality of life overseas. Expatriation filings jumped 102% in Q1 of 2025 versus the previous year. Over 9 million Americans already live abroad. This isn't a fringe movement anymore. This is mass migration in slow motion. Here's the core idea. If you can earn income in a strong currency, US dollars, British pounds, euros, Australian dollars, and live somewhere else where that currency stretches considerably further, you've just given yourself a financial superpower. A remote worker earning $80,000 per year in a major Western city might spend $4,500 a month just to survive on food, rent, transportation, taxes. Move that same income or less to a cost-effective location in Southeast Asia, Latin America, Eastern Europe. The monthly expense can drop to $1,500 to $2,000. That's a significant consideration. But here's the thing, you need income that moves with you, location independent income. Because if your income is tied to a job in one city, one building, you're still anchored to that financial system, no matter where you technically live. That's why income first relocation isn't just smart, it's the entire game. Build the revenue before you relocate, secure the foundation before you move. Don't jump without a parachute. And option two, for those that aren't ready to relocate, or maybe relocation is not on the table, that's okay. But doing nothing isn't an option either. Here's the 5 pillar playbook for weathering this storm from wherever you are. Pillar number 1, non-US stocks gained roughly 12% through mid 2025 versus 2% of US stocks. That's a dramatic difference. Don't keep your eggs in one country's basket. Pillar number 2, reduce single currency concentration. The US dollar index fell roughly 9% in 2025, and it's stated by many reports that it might continue to fall in the near future. Pillar number 3, and one of my favorite, build location independent income. Over 70 million Americans now freelance, contributing to 1.3 trillion to the economy. And within that percentage, the number of earners over 100,000 grew 87% independently within 5 years. Whether you eventually relocate or not, income that doesn't depend on one employer, one office, one geography is the most powerful financial resistant tool you can build in this economy, in this environment. Pillar number 4, aggressively reduce high interest debt. You know this, you know this. Credit card delinquencies have risen almost 10%. Average card rates exceed 21%. If the Treasury yield spike, which to be exactly what is to take place, that will cause a catastrophic ascension of the interest rates. Pillar number 5, build your emergency buffer. 1 in 3 people have zero emergency savings. The median savings is $500. In a storm, that is not shelter, that's an umbrella. And I'm not trying to be rude or insensitive. I understand that we all have debts and we all have things that we need to pay for, and it restricts savings. But if you're planning to stay put, you need to ramp up your emergency buffer. The Canary is singing. Japan, the world's 4th largest economy, it's the largest foreign creditor. Japan is under simultaneous pressure from rising rates, a crushing debt burden, a demographic collapse, an oil shock that they have no control over, and a shadow banking system that's showing cracks that's tied to the yen carry trade. When Japan sneezes, the world catches a cold. When Japan has a financial crisis, the world grinds to a halt. I'm not here to tell you that the sky is falling. I'm here to tell you that the same thing those coal miners understood when the Canary started struggling, The smart ones, they didn't stand debating whether or not the gas was real. They moved. You understand more about what's happening in the global financial system than 95% of the people around you. That's not a party trick. That's real power. The kind of power that lets you make decisions from a position of knowledge instead of panic. I only have one question for you. What does your shelter look like? And shelter does look different to different people. For some, it's diversifying investments and eliminating debt. For others, it's building location independent income and relocating to a place where their money works harder for them. My name is Emerald, and I help individuals and families relocate with revenue. We do this by first identifying your strengths and then building location independent business around that strength. You don't have to wait until your back is against the wall to build your shelter. In fact, you shouldn't. So let's get started. Click on the link in the description below. The first tier is recommended, and that's the place to start. If you're serious about building before you move, start with relocatewithrevenue.com. Thank you for watching all the way through to the end. If this video opened your eyes, share it with someone who needs to hear it. And please like, share, and don't forget to subscribe if you haven't already. Hit the notification bell so you don't miss any future videos like this. I'm Emerald. Stay free, stay informed, and I'll see you in the next one. Thank you.